All right, so yesterday in our class, our technical analysis class for my premium subscribers, our market scholars, we talked about the prospects, the likelihood, the higher likelihood that the S&P 500 would retest yesterday's immediate highs post the announcement. Because remember, we ran up and then immediately came back down, and then just kind of fluctuated by the end of the day today. So I thought, again, we'd probably test those highs by the end of the day. And ultimately we didn't until today, right? Actually, until last night. In fact, after the market closed, by the time I went to bed last night, the futures are up 1%. So through the night and into this morning, we did end up retesting those highs and clearing them. We actually opened up above the high today on the S&P 500. We did not open nor close above the high on the Russell 2000. So we'll talk about that. We also talked about in last night's market outlook video the bullish buy the dip patterns that were showing up on the S&P 500, and obviously we know that those played out here. We'll talk about, okay, now what are our expectations? How bullish are we? There are some very interesting patterns developing on the charts that kind of tell us just how bullish that we should be here going forward. Obviously, today's sector rotation was exactly what we want to see. So a lot of really good bullish patterns from an intermarket relationship. But when you look at the breadth, we'll talk about that and what that means, as there's some very rare combinations of multiple extreme patterns on the breadth. We'll break that down in today's video as well. And then our trade idea is out of the norm. We've been in the technology space for quite a bit, or the QQQ type space for quite a bit. Now we'll take a look at an industrial type name that's having its own breakout today, and we'll talk about trading that. So let's go ahead and get started. Today is Thursday, September 19th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live videos, where I take a look at old Market Outlook trades. And we close out one today. We usually, we talk about management in this video. We also take a look at today's trade idea already, the one you'll hear at the end of the video. We put it on before the market closed today. Come down to the bottom, click this heart. Here, it opens up this tab. Hit that like button that pops up usually right there. Click this thumbs up icon. It takes you to this tab. Click on this like button as well. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's go ahead and get started with the S&P 500. Taking a look at it with the market forecast indicator. As you can see, the intermediate line is still strongly bullish. It was above the 90th percentile going into the FOMC. Obviously remains there now after today. Nice good jump up above. We opened above yesterday's high point and then obviously closed above it as well. Pretty tight range after the gap, but with the gap, a pretty good range when you account for how much we moved from yesterday's close at 56.18 to the low today at 56.86. So you're almost 70 points of gap there. So clearly above the average when you account for that. It brought the near-term line. Remember, this was day one of a potential bearish near-term low point. But we also talked about how we were leaning, because of the oversold momentum line, we were leaning towards it bouncing with the bullish intermediate confirmation signal. And it bounced, right? Definitely did bounce today. Now we're in day one of the near-term line crossing from below, the 40th percentile, now crossing above it. And the momentum line is above it on day one. So now day two, we need to get the near-term line above the 80th percentile. So now, again, it would be more likely for that to happen if the momentum line was above the 80th percentile on day one. Doesn't have to be, but it increases the odds. But at least it's above it, all right? And so that's a good sign that we can get from here, from 50 essentially to above 80 tomorrow as we go into options expiration. This is a pretty decent, it's been a relatively flat options expiration, but now closing with a pretty good move up to the upside here. If you take a look now, it's interesting now that the NASDAQ 100's intermediate line's above 80 and the Russell's, you'll see here in a minute, is above 80. Now we kind of got pretty similar chart patterns on all the market forecast charts. You can see that we bounced out from this level 2. It was not a bullish intermediate confirmation signal because of the pink shading. You only have a bullish intermediate confirmation signal when you have dark green shading. But we bounced nonetheless, and again, momentum line's above the near-term line. The near-term line still below intermediate lines. We need to get up above because it was between the reversal zones there. If you take a look at the Dow Jones Industrials, very bullish. Intermediate lines above the 90th percentile. Bullish intermediate confirmation signal playing out. The near-term line never did get below 40, so it's basically bouncing back up. Well, I guess it got below 40 barely, but is bouncing back up here just like the rest. And then finally your Russell 2000. Also, its intermediate line finally crossing above the 80th percentile for the first time. You see down there at the bottom, almost 5% above the 30-day moving average. Your momentum line bouncing up. Again, we did have dark green shading, so this was an intermediate confirmation signal. We talked about the bearishness of this long upper shadow yesterday, and we still rallied, so still okay, but the top of that long upper shadow is a resistance, so we're not quite done with that yet. We're close, and because we're closing pretty close to it. So we really would like to follow up today's move with a break above that high tomorrow and really clear that resistance and try to clear some of these levels as well tomorrow too. That would be a really good end of the options expiration month, closing going into a new options expiration cycle with a good bullish move. Again, the near-term line really did not get into bearish territory. It's back into bullish territory now. So that, still on the current near-term rally that we have been on. Again, barring that resistance holding here on the Russell 2000. So that's really the only difference. All the intermediate lines are now all above 80. The short-term sentiment's bouncing on all of them. The oversold momentum line, it was oversold on all of them yesterday. It's bounced back up to pretty decent levels today. So all, nice good bounce and nice good bullish pattern across all the indexes. They're not all producing new highs yet, but the S&P is, of course, and the NASDAQ and the Russell, still have some work to do for them to kind of catch up and get to that point as well. But they're close. Let's take a look now at the weekly chart. Excuse me. As you can see, so far a good close to the week, closing above all these highs. We talked about that earlier in the week. That would be a good strong bullish close, and so far we're getting it. Now we're probably not going to close above 56.69. We're at 56.66, so we're pretty close. If we can get a good strong day tomorrow, we probably could close above that high too, and that would be really bullish, right? If we were able to do that. Obviously, we got a higher high and higher close from last week's close, and we're clearly bullish. The PPO is rising again, up to 6%, so clearly on the move, and a pretty decently strong bullish candle as well on the weekly chart. Let's take a look at the 3 green arrows. And you'll notice 3 green arrows across the board, right? We have had 3 green arrows now for multiple days, so we are clearly back on the bullish intermediate trend. We never did get off of it on the diamonds, never really got off of it on the spiders either, but we did on these two, and they have turned around in a good way. If you take a look at the 2-line versions, the S&P is back above the value area on its point of on the volume profile for the last year. So that's a really good sign for the S&P. The MACD and stochastics are turning higher. You can see the MACD histogram here turned up too. We got a good amount of volume today, more than 1.5 times the average volume. So nice, good breakout. Kind of looks like, I've been telling our Market Scholars clients, looks like a little bit of a cup and handle. Since this little bounce right here, we've been talking about this idea of a cup and handle breaking out up above these recent highs. Obviously, the distance between the top of the cup and the bottom of the cup would be kind of what we'd project from the top of the cup. So that's a good bullish pattern too. A nice, good bullish would be a bullish continuation pattern, considering that we are bullish going into the cup and handle pattern. It's a classic. That is like an old school classic technical pattern there. Let's take a look at some of the other oscillators. So we'll go to the DMI for the S&P, and you can see we have finally got above 25 on the positive. It's not And it's not really clear, and we'd like to get above 30 to really clear it, right, and feel good about it. The negative indicator is pretty low. It's already below 15. That's a pretty low indicator to be at. You can see the last times, like last time we were below 15, we were above 30 on the positive indicator. And then these other instances here, when we got below 15, we were also clearly above 30, if not above 40. So to be below 15 and barely be above 25 is kind of goes to show just how not very bullish we are and how much work we have to do to get really going there. The Qs, it looks kind of similar. The negative indicator is not as low. And then your IWM, you can see has a nice good bullish pattern. We did get above 30 on the positive and below 20 on the negative indicators. And your ADX is starting to rise up again. I mentioned today in class that it would be nice to get another parabolic move here on the S&P. Similar, get the ADX up above 40. You have to get your positive indicator above 40 for that to happen. Usually happens a little bit right after we get that positive indicator making its run, and the negative indicator making a run down to extreme lows as well. That would be kind of the ideal scenario here. Let's take a look at the RSI and the CCI. We're back above 60 on the RSI, clearing above the highest level of this past intermediate run, so that's good. We did not get to 150, but we got above 100. We got close to 150. Again, higher than any point we did on the last run. So that's a good sign as well. Very, very good sign for the S&P 500. And you can see similar patterns on the NASDAQ. And then your Russell is also looking pretty similar there as well, despite, again, not closing above these recent highs nor above yesterday's high quite yet. The Ichimoku cloud, we do have a weak trend going. We're still below these lines like we failed at the last couple of times here. So we need to get above those lines to feel good about the possibility of a mature run, which is what happens when you get above the highest line. So we're not quite here. Let me remove that one. There's that highest line there. That's the ideal to get up above, and we're not quite there yet. Excuse me. But still, we're developing a good trend, and that's a good sign. And then finally, for looking at the Bollinger Bands, we are right on the upper band and right on the upper Keltner channel as well. And you can see how close the bands themselves are to breaking back out of the upper, out of the Keltner channel as well, and getting us a renewed bullish move up to the upside, and potentially new green dots on either tomorrow or Monday would be a good bullish sign as well. Let's take a look at today's intraday move. Obviously, we gapped up above yesterday's high. We also gapped up above some prior highs as well, and that makes it to where that would be considered a breakaway gap, right? Not a runaway gap, because we didn't necessarily run away. It was a pretty tight range, but again, it's a breakaway gap because we closed up above that high point. So that's a good sign. That's a good gap. Again, we don't want to fill it in tomorrow, right? We don't want to fill in tomorrow anytime soon. Now, a breakaway gap, there will be support here. Like typically common gaps, there's not very much support at the gaps. But for runaway gaps and breakaway gaps, there are. So there will be some support at today's low, yesterday's high point in that area right there, right around 568. So we'll look for it. So, hopefully we don't test it tomorrow, but if we do, we'll look for some support in that area. Obviously, remember we got the bullish pattern. We got the one touch there. We're back to 100 here, so that's a bullish pattern on the intraday chart. I showed you the range was above average. Sorry, wrong chart. The range was above average when you include the gap. It was pretty tight when you don't include the gap, but when you include the gap, it was like an 11-point range. The volume was also above average. Very good, strong volume. So that actually brings both of these up. Now, we don't want them to go up for too long, because when it goes up, the markets are falling. So we don't want that to go up for too long. Eventually, we want the market to get really boring again and start getting, we got to start getting like 3-point ranges and 4-point ranges to get back below 1%. Because remember, a good trend doesn't take hold until you're back below 1%. And so, we are clearly above 1.25% and not anywhere near being below 1% yet. So we still got some work to do in that regard. And then there's not a whole lot. The volume, there's not a whole lot much lower it can go. We're pretty much establishing the low point for the average over the past year. If you take a look at, I failed to brought this up during the intraday chart. You can see we did get back above the average after having been in bearish territory. We jumped up pretty quickly. We are back up to strong bullish levels above the 90th percentile and above the average. So that's a good sign. And then when you look at that volume, another way to look at the volume here is to look at the money flow. Clearly at bullish levels above the 60th percentile. We are, as we break up to new highs on price, we are also breaking up to new highs on volume, on money flow. So that's a good sign too. That's what we really want to see. That was lacking in previous rallies. It's obviously not lacking in this one. So that's a very good sign for the markets too. Finally, let's take a look at the volatility index. It's down. It did not quite go down below 15, but at least it was down, 10%. That's a good sign. We didn't drop below the 85% mark. That tends to be kind of an extreme low for the markets here over the past year. Pretty much all this calendar year, it's been hard to get or stay below 85. We did at the end of last year, we stayed below 85 for quite a while because the 80s typically the extreme lows. So we'd have to kind of change that mindset here. It would also mean getting below 15 would mean we're getting back below the 200-day moving average for the VIX. So that would be a good sign. And then this is the best sign of all. The VVIX closed below 100. So getting that back below 100 after being above it for a while is a very good sign for the markets. That means we are back to a falling volatility regime instead of a rising regime. So that can also lead, as you can see here, to some more drops in volatility. Again, barring a surprise, you can see we've done this before, but barring a surprise to the upside, I think this is a very good sign for volatility too, getting back below the 100 mark and working our way back down below its long-term average. So again, we can also get entrenched in this new bullish trend up to the upside. All right, now let's take a look at what's driving today's price action. Again, it was a nice, good rebound in response to the FOMC decision yesterday to cut rates by 50 basis points and kickstart a new rate cutting campaign, a cycle. And you can see the Qs really outpacing the market by quite a bit. IWM also outpaced SPY to a smaller degree, but again, the big winners during any kind of bullish move is going to most likely be the Qs, especially kind of bigger moves up to the upside. And that was the case today. All the safe haven asset classes all down. Real estate, the dollar, bonds all down. Commodities rose today. I mean, this was about as risk on of a day as you could possibly get, which is interesting because that means a 10-year yield is moving up higher. And you can see, look at this was yesterday after post FOMC, and then this is today. And we're back above the 17-day moving average. It's interesting to see that the fallout from the start of this cutting cycle is bringing down the short end of the curve, as you would expect. As you can see, the market starting to price in the next cut, right? Because the next cut is going to be as wide as 100% odds of that happening according to the futures market. They're pricing in 100% odds of a cut at the next meeting, which is here in November, right after the election. Eventually this will come up and I can show it to you. So the next cut would be, where are we at? Right now, we are at 475, so we're right around that 487.50 mark. So we're below that now. So the market is it's got to get down to, we're going to be down at the 450, 475, 462, 462.50 is where this is getting. We're only 10 basis points away from that. So the market, you can see how the short end starting to price that in. But the long end is not going down anymore. In fact, it's actually going up, as I mentioned the last couple of days. And so that's making the yield spread, which remember was historically low just about a week ago. We were down at 140 basis points, 135 basis points on the close just a week ago. Well, now we are up to 100 basis points. Still negative, but that's a big change. And as has been mentioned before, you can see the spread between this is climbing higher too. So it's back above zero. It's clearly back above zero now and working its way back up towards its normal range of being at 100, 200 basis points. That's a good sign. That's a good sign for the bond market for it to be recovering. But it's a sign that if the 10-year yield starts to rise again, you remember 2022, rising yields, rising commodities, rising dollar. Well, today, as of right now, we're getting rising yields. As was mentioned, commodities made a big jump higher today too, above the 50-day average and above the point of control on this 1-year chart. So it's a big change in direction. MACD is now positive, stochastics in bullish territory. So you can see commodities and crude oil are making a run back up here, up to the upside. The only thing missing again from that triumvirate is the dollar index, as it still remains at its low range of this past year. And again, remember, there's two different types of a weak dollar. One that's bullish for equities, one that's bearish for equities. The one that's bullish for equities is when the dollar is down against all the European currencies and the commodity-based currencies. So you can see, if you look at today, the dollar is down against everything. The only thing the dollar is up against is the Mexican peso. So that's a good weak dollar. That's obviously, as we can see, obviously it's a bullish move. You can see a lot of these currencies are also up against the yen, and they're all up against the franc, which are also safety trades. So as long as those two are also weak against these currencies, then that means that the markets, if these two can start to gain strength, as you saw, the volatility that we've had over the past 3 months is pretty much a function of the fact that the yen has been so strong, right? And you can see the franc also. So the dollar's been down, but the yen and the franc have been bullish, and that's why we've had a lot of volatility. So as long as they're down too, then that's the good weak dollar. And so we'll see if that ends up occurring here, if the dollar continues to push lower, if we can push down. Now here's a really interesting pattern that's developed with this move. Usually after, when we're coming off of lows and we're starting new intermediate runs, the highs are just starting to build up, right? They're just starting to build up. Well, this is not at 606. The actual new highs ends up being 417. So that's another day. I mentioned to you earlier in the week how rare it is to close above 400. That's where my line is. Well, today is going to be above 400 again. In fact, it's going to be even higher than this level. It's going to be the highest point that we've had. Over here, we close at 420, and you can see about that peak, we close at 442. So having a high, the number of new highs closing at 400 is a very, very large number. As you can see, it's extreme. That's not the only extreme on this chart. If you look at the number of stocks above the 50-day moving average, they're also well above 400. And you can see the average is moving up pretty rapidly, now passing 350. So that's a very strong number. If you look at the number of stocks above the 200-day moving average, flirting with 400, was actually above 400 today. At the highest point, it got up to 401. So that's an extreme level to have. I mean, it's very rare to have both this line and the number of stocks above the 50 above the 400. In fact, you have to go back quite a ways for that to be the case. When you have, it was actually March was the last time, but before that, 2021 really was a clear time where both lines were above. So again, but in this case, we have both of these lines above 400, which is 80% of the 500 stock index. The new highs above 400, which is obviously not 80% because there's like 2,800 stocks, I believe, in the New York Stock Exchange. So that's roughly about, and again, this is just a rough estimate. That would end up being about 14%. So we're right around the 14-15% mark of the stocks in the New York Stock Exchange getting new highs today. That doesn't sound like a lot, but for that index, as you can see, that's a high number traditionally. If you look at the new highs and new lows, which again won't be updated until after that chart's updated that I just showed you, it's still going to be right around the 600 level. I mean, that's very, very high. You can see the average for the new high, for the net highs, right? This is the net between new highs and new lows. It's at 314. Again, we haven't been above 314, and obviously in 3 years, you have to go back quite a bit of time to get to where we were higher, right? So here's 314. We have to go all the way back to pre-COVID, and then 2021, the reopening trade, right? The inflation trade. This was the inflation trade. And we very well may be on that inflation trade. And now, again, another sign of extremity in the breadth is the McClellan oscillator. Now, the McClellan oscillator itself is not, in and of itself, that's a good bullish number, but it's not extreme. The summation index is already above 1,000. Now, we went into this year with a summation index barely above 1,000. And you can see we still went higher for quite a while, for multiple months, but the breadth fell off a cliff because the Magnificent Seven stocks led the way higher. Now, remember, if we do not want that to happen again, because we've already got five McClellan, like these 5 days right here where the McClellan oscillator was negative. These were all Hindenburg omens, right? So any day that we are below zero on the McClellan oscillator going forward from here, if we end up with a pattern similar to what we saw going into the beginning of this year, where we stayed bullish but we went negative, we're going to be very susceptible to more Hindenburg omens. Again, the more we get in the 30-day window, and that 30-day window started here on September the 5th, so we're only 2 weeks into that 30-day window. We do not want that to taper off just like that. I mean, you can see it fell pretty fast once we kind of got established. So that's something to kind of watch out for over the next couple of weeks to see if we start to go sideways and if we start to really lose the breadth. Because as I mentioned, the breadth as it stands all across the board, every new highs, number of stocks above the 50, number of stocks above the 200, the McClellan summation index, all at extremes right now. Hard to start a new bullish move when breadth is at an extreme, unless, as we saw at the beginning of 2024, the Mag 7 can say we will gladly take over. As I've always said, is the best bull case scenario for the markets is for the Mag 7 to take back over again and get going. And you can see we're not quite. Today's move is great, but it wasn't like off the charts. Like we're not back up above the 50-week moving average here. Nor are we back up above the 200-day moving average. We're actually still clearly below all these moving averages. So we have not clearly turned things around yet. And if we start to get more underperformance on the Qs, especially on, say, NVIDIA relative to XLK, then again, that's where we get in trouble, right? Here's the daily chart. Sorry, let's go to the daily chart for this. We really need NVIDIA. We need XLK to outperform the market. And we need NVIDIA to outperform XLK. So it really needs, this is the absolute value of the chart, right? This is the actual NVIDIA chart. But down here, you can see the relative strength chart is still, flirting with that 50-day moving average and not really moving higher anymore. And, these, in the lagging category still. So, good signs in relative strength towards the sector, towards the technology sectors. We're gaining some momentum. So that's good signs. But again, we've got a lot of work to overcome. The weekly chart, which is not looking very good and hasn't been looking very good. And remember, we're showing this with all the breadth indicators all at extremes right now. All right, now that brings us to our trade idea of the day. And today's trade idea is actually outside. We've been doing a lot of trades within the Magnificent Seven area and technology area. Today's trade's not in that area. It's actually in the industrial space. Caterpillar, nice, good breakout move up above some very important high points, that long upper shadow from over here, the high from over here, the intermediate line climbing into the upper reversal zone. You can see the market sentiment rising. Everything's looking pretty good here. Excuse me. When you look at the weekly chart for Caterpillar, you'll notice a good bullish weekly candle. Again, Hakinyashi closed above the last 8 weeks highs. PPO starting to rise up again. So that's a good sign. You have 3 green arrows. The volume today was above average, just like the rest of the market. So that's a good sign. When you look at the 2-line version of the 3 green arrows, you can see the 8 and 17 day are starting to pull away. The MACD is really pulling up. The histogram is pulling up. So we're getting a kind of a new, this is a momentum surge. You get these at the beginning of the runs, and then you taper off. But that means that the MACD's got a good chance to get up to a pretty decently high level. I like that opportunity. Looking at the DMI, now you look at all these other indicators, they'll all be at breakout levels, well above 30 on the positive indicator, well below 20 on the negative. The ADX is just starting to rise. The RSI and the CCI are at good, strong levels. Very bullish. If you look at the weekly CCI, crossing above positive 100 again. Now it did that here a few weeks ago, and after a couple down weeks, we're back at it again, so that's a good sign. The Ichimoku cloud is strongly bullish. You are now at intermediate trend strength. Hopefully getting to mature strength would be the goal that we're looking for. And then looking at the Bollinger Band, you can see we actually close up above the upper band and up above the upper Keltner channel. The bands themselves are outside of the Keltner channel still. And the momentum has just turned positive. We were negative yesterday. It's turned positive. So we have a good chance to really kind of get going here. The bandwidth moving higher. You can see they're starting to move apart. As I said, good breakout patterns. So what I decided to do here was be a little directional. We went to the October, went to that kind of low 30s delta and sold the 390 and bought the 380. It's a $10 wide spread, so I went a little bit more than my normal $500 of risk. But same idea, like about almost a 2-to-1 reward to risk ratio, and a lot of flexibility for timing in case it doesn't keep going up immediately. If it starts to pull back, I've got that much wiggle room before my maximum gain falls out of the 1 standard deviation window. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Thursday night, everybody, and we'll see you all tomorrow.